A massive migration of private wealth is locking retail investors out of the AI sector by purchasing core blueprints before they reach the public market. The Family Office 15 report shows this shift in detail. Eric Schmidt's Hillspire alone completed 15 strategic investments in AI and deep technology during 2025. This chart compares global venture capital to private family wealth. While traditional venture capital is a major force, global family offices now control an estimated $3 trillion in assets, creating a primary center of gravity for startup funding. In 2025, more than a third of this total capital pool was funneled into artificial intelligence, advanced software, and next-generation computing. Billionaire investors are deploying capital directly into private companies to take substantial ownership stakes, bypassing the listing requirements and public accessibility of traditional exchanges. These family offices are no longer just preserving wealth. They are acting as capital deployment engines to control the infrastructure of the next decade's economy. While financial headlines focus on public AI stocks, the foundational layers of this technology are being captured by private entities. The capital rush involves the most influential private vehicles in tech, including Jeff Bezos's Bezos Expeditions. It includes the various private entities linked to Peter Thiel, and it extends to billionaire allocators like Laurene Powell-Jocks, Barry Sternlicht, and Lucas Walton. For a tech founder, this creates an immediate choice: pitch to traditional venture capitalists or seek out these unconstrained family wealth pools. For the individual investor, the challenge is generating meaningful returns when the highest growth AI companies are removed from the public market. Navigating this shift requires a strategy based on whether you are seeking capital or seeking a way to invest alongside it. Family offices utilize what is known as patient capital. Because they invest personal wealth, they are not bound by the 10-year fund life cycles that force traditional venture capital firms to seek early exits. This matrix shows the structural differences. Traditional VCs must answer to external partners. Family offices operate with total structural freedom and zero external reporting pressure. This allows billionaires to fund projects requiring decades of deep tech research, like next-generation computing. For a founder, the trade-off is strategic freedom in exchange for the missing scaling playbooks and industry networking that a Tier 1 venture capital firm provides. For the broader market, this means tech companies stay private for much longer periods. Patient capital directly bottlenecks the IPO pipeline, significantly delaying the moment a company finally becomes available to public investors. When companies stay private longer, the rapid growth phase of their valuation happens entirely behind closed doors. This graph illustrates the shift. When a startup's valuation jumps from $50 million to $5 billion, this upward slope is captured exclusively by private investors. By the time a company files for IPO, the rapid growth curve has flattened out. Retail investors are protected from the extreme failure rates of early-stage startups. However, they are also restricted from early-stage wealth generation and typically buy in at mature valuations. This structure, combined with more than 120 disclosed billionaire investments in AI over a single year, shifts the primary growth engine of the sector away from public participation. This concentration of wealth into a single sector drives up AI startup valuations and creates a competitive environment for engineering talent. This flood of capital accelerates the development of AI infrastructure, while concentrating ownership of those foundational technologies within a small circle of ultra-wealthy investors. Surviving this landscape requires a specific playbook. For tech founders, the goal is identifying when to prioritize family office wealth over traditional venture capital. The first rule: target a family office if your project requires a long research runway without immediate pressure to monetize. But if your startup needs the aggressive, structured growth of a traditional VC, family office capital may not fit. You must vet the strategic background of the family office to ensure their technical expertise matches the needs of your company. The choice of capital depends on matching the operational timeline of the technology with the investment horizon of the funding source. Public market investors must recognize they cannot co-invest alongside billionaires at the seed stage. As shown in this playbook, searching for the next AI breakthrough in public microcap stocks is ineffective. Private capital captures them early. Instead, target public hardware and energy suppliers these private startups must purchase from to scale. NVIDIA is the clearest example. As the build-out of global AI factories accelerates, it acts as a public toll booth for private innovation. While you may not own a private software company, you can own the public infrastructure they are forced to use. Investors like Eric Schmidt are currently acquiring the blueprints of the AI economy. To succeed, you must move past waiting for public IPOs, accept the reality of a private-first tech market, and align your strategy with the current flow of global capital.